Good afternoon, everyone, and welcome to NOVA 401k Associates webinar on Introduction to 401k Plans for Plan Sponsors. We have included a handout of the slides for your reference throughout the presentation. To access, just click the handout drop-down in your GoToWebinar panel and save a copy to your local computer. Today's presentation will be presented by Charlene DeMartini, a Senior Account Manager out of our Dallas office, and Karen Degenhart, an Assistant Team Leader. If you have any questions, please type them in the questions box and we will answer them at the end of the presentation. Karen, we're ready when you are.
All right. Whoops. Good afternoon. Thank you all for taking the time to join us today. I'm excited to be sharing some helpful information with you. As the webinar begins, please feel free to use the chat box to ask questions as they arise. If we don't get to all the questions or cannot answer any, we will be sure to follow up in the next day or so. And as always, feel free to reach out to your NOVA account manager with any questions you might have as well. The information in this presentation is general in nature and not intended to be a substitute for legal or tax advice. Please consult a qualified professional such as an attorney or accountant if you need legal or tax advice. CPA credits. NOVA's provider number is 009820. You will need to register individually. You must be present for the entire seminar, complete the evaluation form at the end of the seminar, and you will receive certification within 1 week. Today, we're going to be talking about 401k plans, specifically roles and responsibilities of everyone involved in your plan, NOVA's cybersecurity measures, 401k basics, the moving pieces within a 401k plan, distribution basics, loan basics, and your annual compliance calendar. First, we're going to start with cybersecurity. As you know, there is a lot of money in 401k plans, and fraudsters have also taken notice. Your plan's record keepers, Voya, John Hancock, Mass Mutual, and all the others bear the brunt of cyber attacks against your employees' sensitive data and their retirement nest eggs. So they're putting a lot of security measures as well as enhancing those measures already in place. Cyber attacks can start as a phishing email to one of your employees. If successful, those attackers can then contact your plan's record keeper and reset passwords, change addresses, and request loans and distributions on behalf of your participants. With ACH and wires, typically only trivial amounts are able to be recovered after a theft is discovered. And so you want to be careful what kind of information is being shared, and you also want to be careful that your employees understand how phishing scams work. On our end, with NOVA and also your record keepers, at times it may seem that the hoops that you or your participants may need to jump through to process a simple distribution or loan may seem silly or overkill, but the hoops are in place for a reason, and that is to protect your employees, their savings, and to protect you from potential liability. You all have Fidelity Bonds, probably fiduciary insurance, EEO insurance on your companies, but cyber theft is not covered by these types of insurances. And it's for this reason that we all need to be alert and do our part to prevent fraudsters from succeeding. In the daily administration of your plan, the annual testing and occasional questions that need to be addressed during the year, there's a lot of data getting passed around. Annual census files include social security numbers, dates of birth. Payroll files include social security numbers and addresses. Beneficiaries forms have social security numbers and addresses. Even the reports given to or sent by your financial advisors can have sensitive data provided on them. So we want to make sure everyone involved in transmitting the information for your plan is doing it in a secure manner. Unlike some other industries that are able to replace sensitive data like social security numbers with other types of identification, because we work with IRS and tax regulations, most everything we do relies on social security number identification. Of course, our software is designed to mount Social Security numbers on as many reports and files as possible, but they are still present on other things, such as your employees' W-2s, K-1s, Schedule Cs, 1099s for distributions, and other files and reports. These types of files, reports, and data should never be sent via email without encryption. But even email is not the most secure way to transmit data. Again, even when encrypted, email is still not the most secure way to send sensitive data. So what does NOVA do to protect your data? NOVA uses Plan Sponsor Link as a secure place to upload and house sensitive data for your plan. NOVA Plan Sponsor Link also has a secure web portal called Secure File Exchange, which allows for secure transmission of data from plan contact to NOVA and vice versa. If you haven't used it before, I suggest you check it out. If you have any issues logging in or making an exchange, just reach out to your NOVA account manager. There's also a link to this portal at the bottom of every NOVA employee's email signature. NOVA does also use an email encryption software called Zix, which allows us to send encrypted emails. However, our preferred method is to use Plan Sponsor Link and its secure file change utility to best ensure the protection of your sensitive data. It is NOVA's policy that all new plan contacts be authorized by a current contact under the plan. So no one will ever call NOVA's office or an account manager out of the blue and ask to be added as a contact to your plan. We will require that someone that we know at your business who is already a contact on file authorize us to add any future contacts to the plan. NOVA has internal cyber training throughout the year with required training each quarter for all employees. This includes, during the year, NOVA has different tests that it gives its employees, phishing tests, scam tests. They do try to trick us to see if we fail any of these tests, and if we do, we are subject to even more training. So they are definitely on the heels of the fraudsters and trying to stay ahead of the game and think of what their new employees will be before they actually come out to the employees. We are always being tested for that and trained. NOVA employees are also required to change all passwords. This includes all internal NOVA passwords, all of our record keeper passwords, our passwords with Voya, John Hancock, Mass Mutual, and every other system under which we use, even Plan Sponsor Link and Secure File Exchange. All NOVA employees are required to change these passwords every 90 days. NOVA employees are also trained to remove all PII, that is personal identifiable information, from emails on a regular basis. This includes deleting files from all folders, including our inboxes, sent items, and deleted items. If any PII is missed, NOVA's email system also automatically deletes emails after a certain amount of time. So we do our best to make sure that any of your plans or your employees' sensitive data is not held on our system for any longer than it needs to be. So that's an overview of the things that NOVA does to protect you and your employees' data. What can you do? One thing we ask of all of our plan sponsors is that they use the census function of Plan Sponsor Link to submit your annual census data to us. This is because, again, email, even encrypted email, is not the safest, most secure way to send sensitive information. Using the Secure File Exchange or uploading directly to Plan Sponsor Link is going to give you an extra layer of protection to ensure that that data that you're transmitting to us stays safe and doesn't fall into the wrong hands. We ask that you use the Secure File Transfer feature on our website to transfer other sensitive data to us as well. Outside of the census, this could be K-1s or any kind of data that we need to do a correction on the plan or do a illustration on the plan for you. Anything that would have names, social security numbers, address, date of birth, anything like that. We do want you to use the secure file transfer feature instead of emailing directly to us. We also want you to try to limit the number of people copied on emails. You would be surprised the amount of sensitive data we receive on a daily basis via regular email with multiple people copied. When this happens, not only is there now sensitive data in my inbox and in your sent items, but also in the inboxes of all the folks that were copied. Now you have to think, does each person I'm about to copy really need this information? Does the people I'm about to copy know how to properly handle this information? And are any of them at risk for a phishing scam? Those are the types of things you want to think about before you email something and or copy someone on that email. While it is NOVA's policy to copy the plan's advisors on email interactions, because we do want to make sure that we are communicating consistently with them and keeping them in the loop, we do still limit the amount or the type of data that we will include in these emails for security purposes. And all plan advisors do have access to both Plan Sponsor Link and Secure File Exchange, so they are able to receive and send data through those utilities as well. Remember, when you send something via email, it doesn't disappear from your email once it's sent. You hit send, now it's in your sent items. You delete it, now it's in your deleted items. It's like getting gum on your shoe. It just gets stuck everywhere and never completely goes away. So we want to be very cognizant of what we email back and forth. And lastly, be sure you are using complex passwords that cannot be easily guessed, and be sure to change them often. Now let's change gears and talk about how all of your 401k parties work together. All right. Okay, sorry, I had a little blip there. Okay, how do all your 401k parties work together? With most of the plans here at NOVA, there's a team of professionals who all have a part in your plan's successful overall operation. Kind of like a four-legged stool, each leg does an important part in supporting the plan. While today's webinar focused mainly on NOVA 401k, we would be remiss to not mention the other parties involved in successful plan administration. First, there's you, the plan sponsor. After all, this is your plan. Your leg of the stool supports the plan through overall fiduciary responsibility, communicating your plan to your employees, timely remitting plan contributions, and providing data to NOVA and other parties on an annual basis. Next, there's your plan's advisor. Your advisor's leg of the stool supports the plan through record keeper vendor selection and monitoring, coordination of plan enrollment meetings, employee education, investment education, and 404C compliance. On the bottom left of the stool, your plan's investment provider's leg supports the plan as custodian. This is the party who holds the actual assets of the plan, the money. They invest the plan contributions, they provide daily record keeping of those investments and accounts, and they provide participant statements, process distributions from the plan, and ensure proper tax withholding and tax reporting. On the bottom right, you see NOVA's leg of the stool. Our job is to support your plan by preparing and maintaining your plan's legal document, completing all required annual testing, prepare annual filings, such as the plan's 5500 and SSA, and provide ongoing plan consulting support. NOVA also does informational webinars like this one throughout the year to not only educate you, but also give you a very good reason to disconnect from your regular duties for just a little while. As you can see, each of the four legs, you, your plan's financial advisor, your plan's investment provider, and NOVA, we all play an important role in the overall success of the plan. Each leg relies upon the others for certain aspects of the plan, but while we all have our own individual parts and duties, we all strive to work as a whole to provide seamless administration of the plan from year to year. Okay. What is next? Now that we've covered roles and responsibilities and cybersecurity, let's get into some 401k basics. What is a 401k plan? A 401k plan gives employees the opportunity to save for retirement on a tax-preferred and tax-deferred basis. Studies show that payroll deduction is the best way to save for retirement. Why? Because if you take it home, you're going to spend it. 401k contributions come out of an employee's paycheck automatically before they can spend it. For many people, their 401k is the biggest asset outside of their home. 401k plans become the primary form of retirement savings for most workers. So a 401k is generally the most valuable benefit you can provide your employees. Yes, health insurance is important. Employees' kiddos being able to get braces because they have dental insurance is important, but a 401k is the one benefit that an employee can benefit from the rest of their lifetime. You can probably make an argument about braces too, but really. Yet nothing comes for free. 401k plans are heavily regulated by both the IRS and the DOL, the Department of Labor. How hard can that be? When dealing with government regulations, there are more gray areas than black and white, and common sense does not always win. When you do seem to think you have things figured out, the rules related to 401k plans are always changing. As I stated earlier, one of NOVA's responsibilities is to provide the plan's legal document. This is a written document that describes all the rules within the plan. All the rules within the plan must lie within both IRS and DOL, Department of Labor regulations. So if you can imagine, the governmental regulations related to 401k plans is a big house. And each individual 401k plan has its own room within that house. The rooms within the house do have some discretion. They can do what they want. However, they must adhere to the overall house rules at all times. Anything that is done under the plan, whether it be who you let into the plan and when, what types of contributions you give to employees, the plan's vesting schedules, types of distributions, loans, retirement ages under the plan, everything must not only follow DOL and IRS house rules, but also the plan's written legal document. That being said, anytime you want to change something or you are doing under the plan, anytime you want to change something you're currently doing under the plan, or you want to add an option or take something away, we must view that change under both the lens of the current written plan document and under current IRS and Department of Labor regulation. For example, say you have both salary, let me go to the next slide here. Say you have both salary and hourly employees. If you, as plan sponsor, wish to exclude hourly employees from the plan document must be written in a way that excludes hourly employees. That seems easy enough. But we must also ensure that the exclusion doesn't violate any IRS or Department of Labor regulations, and also that the plan still passes IRS plan coverage testing after the change is made. So before we make any document changes, we here at NOVA are going to make sure it is not something that is going to land you on the IRS or Department of Labor naughty list. And we're going to do our best, We can't predict the future, but we are going to do our best to ensure the change you are making will not negatively impact you or the plan in the future, whether it be due to future testing failures or future increased employee contributions and so on. Let's look a little deeper into what IRS and Department of Labor does in regards to 401k plans. IRS requires plan compliance with federal statute and IRS regulation. It is the IRS that requires the annual non-discrimination testing that you've all probably come to love, and you see coming from your NOVA account manager every year. Non-discrimination testing basically tells the IRS that your plan is not discriminating in favor of owners, key employees, or other highly paid employees, but it shows that the plan is a level playing field across all employees as a whole. IRS determines taxable events and plan deduction limits for tax purposes. They determine contribution limits each year. And they also require that plans follow a legal, written document and that the document be timely amended when necessary. Where the IRS focus on plan rules, limits, and tax implications of a plan, the Department of Labor focuses more on the employee side of things. The Department of Labor ensures that employee contributions and loan payments are deposited to the plan in a timely manner. DOL ensures the investment lineup provided to the plan's participant is reasonable. They ensure plan expenses are reasonable. And they want to know that the plan is properly communicated to employee. And the Department of Labor waits with bated breath to see the plan's annual 5500 filing each year. We will talk about the 5500 in a little more detail later. Oops. So let's look at an example of what the Department of Labor might be looking at inside of your plan. And I'm having a little hiccup here, just bear with me. Okay, Department of Labor. They may come to you and say, what is the preferred investment alternative for an employee who puts money into the plan but fails to make an investment election? So say you have auto enrollment, or you have an employee who starts deferring, but they never filled out the investment form, or they never made an election online at the vendor to say how they want their contributions to the plan invested. The Department of Labor has rules on that. So if you're asked this question and your plan is compliant with Department of Labor regulation, your answer should be, oh, they're invested in a balanced fund or a life cycle fund. And here is a prime example of how rules continually change, because until fairly recently, money invested in money market or stable value fund would have been a good answer. As you know, money market, stable value funds, they don't lose a whole lot of money when the market goes up or down, but at the same time, they don't gain a whole lot of money over time either. They just kind of stay the same. The reason for the change is that Department of Labor realized that holding employees' funds in money market or stable value funds does not provide any growth of retirement funds. So it's now considered imprudent to hold employee funds in these types of investment vehicles unless specifically requested by the participant. So while a few years ago, if an employee did not make an investment election, you can just throw them in a money market and let them there until they chose to do something otherwise. That is no longer the case. Today, an employee must be invested in a balance fund or some sort of life cycle or target date fund that will provide better investment growth over the years that the money sits in that vehicle. The Department of Labor is concerned with timely deposits of employee contributions into the plan. And actually, this is probably the most common error made by plan sponsors. If you're a small plan, less than 100 participants, once a contribution or loan payment is withheld from an employee's check, those funds must be deposited into the plan as soon as administratively feasible, but never more than 7 business days after the funds were withheld. But don't wait. They do give you 7 business days. They don't want that to be the default. You know, you can get to that 6th business day and you could have a computer error, or the electricity could go out due to a storm, and for some reason you don't get that money deposited into the plan within that 7th business day. These things can happen, and Department of Labor doesn't give you a do-over. So you do want to go by the as soon as administratively feasible option, and leave the never more than 7 business days after the funds are withheld as last minute, last resort, emergency resort. You see, if you as the employer hold on to those funds any longer, the Department of Labor looks at that as a loan from the employee to you. They tend to frown upon that. And if funds are late, corrective calculations are required to be made to the plan to make up for lost investment earnings due to the funds being held out of the market for a longer amount of time. In other words, should something like this happen, you need to make a correction to the plan to make that employee whole. Now, if you're a larger plan, over 100 participants, withheld funds must be deposited into the plan, again, as soon as administratively feasible, but never later than the 15th business day of the month following the month the funds were withheld. Note, again, that the sooner of ASAP or the 15th business day of the following month is what we're looking at here. If your employee contributions are consistently held any longer than necessary, a correction will need to be made. This is especially important with larger plans because, you know, your larger plans are required to have an independent audit each year. And more than likely, one of the first things that CPA is looking for when they're doing that independent audit is when the pay dates were during the plan year, what date those contributions were withheld from your employees' checks, and how many days it took for those contributions to be deposited into the plan. So you want to be very cognizant of your operations, of how long it takes to get those deposits put into the plan. Timely deposits of employee contributions are a pretty big issue with the Department of Labor as well. If there's one thing that you can change right now to stay off the Department of Labor's radar, it would be to ensure that your employee contribution deposits are timely. Again, for a small plan, you want to have them deposited as soon as feasible, no later than 7 business days after the date they're withheld from the employee. For a larger plan, again, as soon as administratively feasible, but never more later than the 15th business day of the month following the month in which the funds were withheld. Okay, the 5500, we touched a little on the 5500 a few slides ago. Just a quick overview on what the 5500 is. 5500 is like an annual tax filing. However, it's really just an informational return. This filing tells the Department of Labor where the plan started, how many assets were in it, how many participants did it have, what was added and taken away during the year. what the major plan options are, whether or not there are loans in the plan, and other information that the Department of Labor uses to ensure plan compliance. The annual 5500 cannot be mailed. It must be electronically filed through the Department of Labor's FIRE system, and this is something NOVA does on your behalf each year. Generally, you will get a draft of the 5500 sent to you with instructions on how to electronically file the 5500, and there's always help if you have any issues with either getting your signing credentials to sign and file the 5500, or any questions that you have on the 5500, you can always reach out to your NOVA account manager and they can help walk you through that. For the Department of Labor's electronic filing system, you have to acquire your signing credentials only once. Once you have them, you use the same credentials every year. Once that 5500 is electronically signed by you, it comes back to NOVA and it's sent on to the Department of Labor system to be electronically filed pretty much immediately. So it's a pretty seamless process. Hardest part of the whole thing is getting your Department of Labor signing credentials and remembering what they are every year. The annual 5500 also reports the amount of the plan's Fidelity Bond. So the Fidelity Bond, the ERISA bond, this is what covers the plan for employee theft. So you had a payroll person who was supposed to be contributing, taking money out of employees' paychecks and contributing to the plan on the employee's behalf. This was your payroll person. One day they don't show up at work, they're gone, and you realize that that employee had been taking home the employee's contributions instead of putting them in the plan where they should have been. That is something that the Fidelity Bond or the ERISA bond, that's what that is going to cover, employee theft. Basically anything that could happen to the money between the time that it's withheld from your employee's paychecks to the date that it gets deposited into the 401k plan. The Fidelity Bond amount is required to be at least 10% of the plan's assets with a maximum amount of $500,000. And the amount is actually reported on the annual 5500. And this is one reason your plan's account manager at NOVA may bug the tar out of you annually to verify the amount and or increase the bond coverage. We don't want to ever have to report insufficient coverage on your plan's 5500 and possibly set up a red flag to the Department of Labor for you. Large plans. Those with large plans, 100 or more participants that require an annual CPA audit are also required to attach a copy of the independent CP audit to its annual 5500 filing. So depending on how big your plan is will depend on how many schedules, how big the 5500 is, what kind of attachments it has. But no matter the size of your plan, you do have to file every year. It does have to be filed electronically, and you do have to report the Fidelity Bond coverage on your 5500 each year. Okay, so now we're going to really change gears, and we're going to talk a little bit about payroll integration. I think I went a little too far on the slide. There we go. Payroll integration is when your payroll provider submits full census each payroll period directly to the record keeper. This census would include all data for employees, whether they are deferring or not, all the data that's necessary for annual and ongoing plan administration, addresses, compensation, plan contributions, hours, dates of hire, dates of birth, dates of termination. Why would you use payroll integration? You would use payroll integration because it simplifies the process and allows the record keeper to do more things for you. Annual census can be pulled directly from your vendor record keeper rather than asking you to complete it each year. Distributions to terminated employees can be automated. Once a termination date is received in the census file, your 401k vendor can send distribution packet to that participant. If their account is under $5,000, participants can be forced out if no response is, if no response comes 30 to 45 days, depending on which vendor you have. We call those automatic cash outs. Keeps the participant count of your plan down, keeps the potential of a plan audit of your plan down, and also can lower the expenses within the plan by keeping those smaller accounts out of the plan and distributed out to the participants. It also allows vendors to track enrollment, which is especially great for plans with auto enrollment. Once new employee data is received by the vendor, they can submit enrollment packets to participants automatically upon eligibility. And it also allows your census data to be always up to date, which helps all parties, all legs of the stool, run the plan smoothly. There are two types of payroll integration, 360 and 180. Payroll 360 is where census data flows both ways. Census data is provided to the record keeper from your payroll provider. Payroll changes are provided to the payroll provider from the record keeper, like deferral changes, hardship requests, loan requests. So your payroll provider is supplying all the census data one way, and then the vendor or record keeper is providing your payroll provider with loan payments and deferral percent changes and stuff like, and auto enrollments and any deferral changes that need to be made under the plan. With Payroll 180, your census flows one way. Census is just provided to the record keeper from a payroll provider. Both of these can help ease the administrative burden that you have under the plan. Many of the vendors that we work with do have options to work with payroll providers either on a 180 or 360 basis. Your account manager or your representative at your record keeper may have more information on payroll integration, including what they have to offer and which payroll companies they currently work with on 360 and 180 integration. If that's something you want to look into, reach out to your plan's account manager, and they can probably get things started for you and at least get the right questions answered so you can see if that would be a benefit for you. Okay, now we're going to switch gears again and talk about non-discrimination testing. Non-discrimination testing is a series of tests that essentially proves to the IRS that your plan is not discriminatory in favor of owners or higher paid workers of your company. The ADP testing is part of non-discrimination testing. ADP testing compares the amount of deferrals that highly compensated employees make to the amounts of deferrals that non-highly compensated employees make. Your NOVA account manager may refer to highly compensated employees as HCEs. Non-highly compensated employees may be referred to as NHCEs. We do love our acronyms in the retirement industry. ADP stands for actual deferral percentage. ADP failures are usually corrected by issuing taxable refunds to highly compensated employees, which brings the ADP average percentage down for the HCEs to a percentage more comparable to the non-highly compensated employees. So when we test for ADP, we're looking at the average deferral rate of all of your highly compensated employees, lumping them into a class. We're seeing what their average deferral is. And then we're doing the same for all of your non-highly compensated employees. And then we're comparing those two average percentages. As long as they fall within, say, 2 percentage points of each other, the IRS says, okay, good to go. No corrections are necessary. However, if the highly compensated employees have an average deferral rate that is more than 2 percentages above your non-highly compensated employees, that is when we have to start issuing refunds to bring that percentage down. That's when you get that email and that phone call from your NOVA account manager after testing is done saying, hey, I'm sending you this form that we have to have signed so that we can do a refund to, you know, X, Y, and Z employee because the ADP test failed. Failure in the sense of non-discrimination testing, it probably should be called something else. It's really not that bad. It doesn't mean you did something wrong or you did something bad. It just means that the percentages are a little out of whack and we just have to do something to bring them more in line. So it's not something to panic about if you do get that phone call or that email that there was an ADP failure. Failure is kind of a strong word. Unfortunately, that's what it's called. But it's really not that bad, and it is. It's just a normal routine test that's done on all 401k plans, and it's done every year. And some years you may have refunds, and some years you may not have refunds. It really depends on how much your non-highly compensated employees defer during the year. So all this talk about highly compensated and non-highly compensated employees, what is a highly compensated employee, an HCE? A highly compensated employee is any employee in the testing year who earned more than a certain amount in the prior year. For example, an HCE, a highly compensated employee in 2020, is anyone who earned more than $125,000 in 2019. Now, this $125,000, this amount is indexed by IRS every year, so it will increase yearly or nearly yearly. It's kind of been going up maybe $5,000 a year pretty consistently. Some years it doesn't change, some years it does. So it's anyone, for 2020, it's anyone who made more than $125,000 in 2019. If you made more than $125,000 in 2019, then you're a highly compensated employee in 2020. It's also anyone who is a greater than 5% owner in the company. And when we're looking at owners of the company, we also have to look at lineal family members or spouses of people who own parts of the company. That is why that's one of the reasons why when we send out our annual census request every year, you'll notice that one of those tabs is about family members. And that's really important because you may have a child or a spouse that has no ownership in your company at all, but because they work for the company and they are related to you, they are an owner, and they have to be tested as such when we do the annual non-discrimination testing. This is called owner attribution. You know, cousins, not a big deal, brothers, sisters, not a big deal, but if you have children, spouses, grandparents, grandchildren working for the same company in which you are an owner, you do want to make sure that you alert your ANOVA account manager of those relationships so that we can make sure that the testing is done properly each year. Top-heavy testing. You get your annual compliance testing package every year, and the very last test in that package is usually the top-heavy report. Top-heavy is, a plan is top-heavy if we take the entire balance of the whole plan and the key employees of the company hold more than 60% of that total balance. When a plan is top-heavy, plans can be required to make an additional employer contribution to those non-key employees. So that is an important test. And NOVA is going to run this test every year. If it's nowhere near 60%, we're going to put it in the packet and we're going to send it to you, and we're not going to make a big deal out of it. But once that test starts to creep up towards 50% or higher, we're going to start calling you and saying, hey, your top heavy is getting up there. You know, let's look at plan design, or let's look at what might happen should your plan become top heavy in a future year, because what we don't want to happen is for you to be surprised by an extra contribution that we tell you you have to make in order to satisfy IRS non-discrimination testing. Key employee. Key employees are important in the top heavy determination. When we're looking at key employees, they're a little bit different than a highly compensated employee. So a key employee is anyone with greater than 5% ownership in the company. Again, we do also have to look at lineal family members in order to determine ownership attribution. So again, when you're filling out that annual questionnaire, very important that you're taking care in answering those questions completely so that we know who's a family member and how are they related to any of the owners of the company. A key employee can also be someone who owns less than 5%, but more than 1%. So a 1% owner who makes greater than $150,000 a year. That would also be a key employee. An officer of the company. So you have a vice president or some defined officer of the company whose compensation is greater than $175,000 a year. That would also be a key employee. Now, the lineal family member, the ownership attribution, that doesn't count for officers. It really only counts for employees that own directly 5% or more of the company. So again, when we send out those requests and we start asking questions after we get those census files back, you know, one of the first things that NOVA does when we get those census files, we're looking through those names and we're going to see, oh, this guy has the same last name as the owner. Let's make sure they're not related. You know, so we're going to kind of look for those relationships. We're going to check what you told us when we took over the plan. We're going to look at those relationships. We're going to look at the ownership percentages, but we know these things change. So each year, we're going to keep asking, did any of this change? Are there any family members working for the employer? What is your ownership percent? We do like to see 100% ownership. That way we know we have all owners accounted for. And then each of those owners, we're going to ask, do they have any family members that are also working for the company? So there's really good reason that your account manager at NOVA asks these questions each year. It's really not just to drive you crazy, but it is an important piece of the puzzle when we're doing the annual non-discrimination testing. Now, for the most part, a safe harbor plan is not subject to testing. For the most part, there can be times where you have a safe harbor plan, but due to certain contributions that you've decided to make during the year, we may still have to do some ACP testing. But for the most part, safe harbor plans are exempt from ADP, ACP, and top-heavy tests. And there's a couple ways to become a safe harbor plan. I believe the last webinar that NOVA gave was on safe harbor plans. And if any of you want to have a copy of that webinar, reach out to your AM and we can probably get that to you, or we can make sure that you are alerted before we do another webinar in the future. We're not going to go into it too much during today's webinar, but it may be something that you want to look into in the future. There are two types of safe harbor plans, basic match formula and non-elective. All safe harbor contributions are 100% vested at all times. And when you do have a safe harbor plan, generally for the most part, like I said, the ADP and ACP and top heavy tests are waived. They're deemed to pass. There are also other non-discrimination tests that apply to 401k plans. We are not going to go through these in detail. There's coverage testing, there's profit sharing testing, there's compensation testing. These don't apply to every plan in every circumstance. You know, it's just nice to know the terms, know that they're out there, so that if ever something does come up, you can have a little bit of familiarity about the terms. Okay, I think I'm kind of running short on time here, so I'm going to speed it up a little bit. Timely amendments of plan documents. Remember, your plan has to have a legal written plan document in order to operate. And these plan documents have to be amended from time to time to stay current with new legislation or new IRS regulation. When these amendments go out, they do have to be executed timely, generally by the last day of the plan year in which the amendment applies. And there are penalties for failure to execute timely documents. Your plan document, your plan document is going to cover all of the in and outs of the plan, all the workings of the plan, who is eligible, when they enter the plan, what types of compensation we're using to run the testing and to allocate employer contributions, what the vesting schedules are, what kind of distributions are allowed in the plan, when the retirement dates are in the plan. So pretty much any question you might have, you're going to find the answer in your plan's document. But again, you also have your NOVA account manager that you can reach out to at any time. We can review the plan document with you at any time. We can also answer questions or direct you to the right place in the document to find your answers. The most common plan sponsor payroll errors. So let's go over these real quick. Excluding bonuses from your deferral elections. A bonus pay is a pay. It's a W-2 compensation pay. So unless your plan document specifically excludes bonuses, you want to make sure that you're deferring from all pay periods, even those bonus pays. If you're not sure if your plan excludes them or not, reach out to your NOVA AM account manager. Excluding part-time employees from the plan. IRS does not like to see part-time employees excluded as a class. You can exclude an employee who works less than 1,000 hours, but you can't exclude an employee just because they are part-time. Basically, if an employee works at least 1,000 hours in a plan year, they cannot be excluded due to part-time status. There are ways around this, and that is something that you would have to reach out to your account manager to discuss. But just as a basic overview for today's purposes, you want to be careful that you're not specifically excluding part-time employees from your plan. Matching catch-up separately from non-catch-up contributions. Matching Roth contributions separately from pre-tax contributions. You want to make sure, Roth and pre-tax are the same going into the plan, they're just taxed differently. Not distributing the summary plan description to your plan participants. Not allowing new employees to participate in the plan pursuant to the plan document. And not capping annual match contributions based on the annual compensation cap. And here's a few examples we'll go through real quick. For not allowing participants to enroll on time, ABC Company's plan has no age or service requirement, but does not offer Steve enrollment into their 401k plan for 6 months. So Steve went 6 months without being allowed to defer. Now ABC Company is going to have to make Steve whole by making a fully vested employer contribution in the amount of the missed deferrals and the employer match on behalf of Steve to the plan. and also getting him enrolled right away. Next example, not properly capping the matching contribution. So the IRS has a compensation limit every year. For 2020, it's $285,000. So if you have a 4% match in the plan, times 4%, you cannot exceed a match of $11,400 because the compensation is capped at $285,000. This particular example here does 50% on the first 6%, then the maximum matching amount any one participant can receive is $85.50. So you always want to make sure that you're not matching past that $285,000. Oh, initial eligibility example, 1 year of service with semi-annual entry dates. This is a person who was hired June 1st, 2019. He needs 1 year of service to be eligible, and he would enter the plan on the following July 1st or January 1st, whichever comes first. So he was hired June 1st, 2019. His 1 year of service would be met June 1st, 2020, so his service has been met, but now he has to wait until the next semi-annual entry date, which would be July 1st, 2020, and that is the date that he could start contributing to the plan. Dealing with rehires. Don't hire them. No, I'm just kidding. Dealing with rehires, you want to be careful when you bring back a rehire, when you bring back someone who previously worked for you, especially someone who was participating in the plan when he or she left. If a former eligible employee ever had a single vested dollar in the plan, this would include deferrals, which are always 100% vested, they never lose their prior service. So somebody could be gone 15 years and come back, but you still have to treat them as a rehired employee and bring them back into the plan. Now, if someone never had any vesting in the plan, that is when you can disregard their service after they have been gone for 5 consecutive years. But again, deferrals are 100% vested. So if an employee ever deferred $1 of his or her own money into the plan, you would need to make sure that you honored that prior service for that employee. Now, this is something that NOVA can help with. It's also something that your record keeper can probably help with. One good rule of thumb is if you have an employee and you're rehiring them and you're not exactly sure what to do with them, reach out and let us look at that participant's prior history and make sure that you're handling them properly when they come back into the plan, so that we're not doing a correction, you know, a few months or a year down the line because they were handled incorrectly. Okay, so that's the end of my part of the webinar. Sorry I had to rush through those last couple slides kind of quick. For my clients out there listening, just so you know, there will be a quiz, and I will have that emailed out to you by the end of today. Just kidding. But I'm glad you all were able to join today. I'm going to pass the webinar over to Charlene now, and she's going to talk about the moving pieces of the 401k plan, which is going to include distributions, loans, and also the annual compliance calendar. Charlene, you ready?
I am, thank you.
All right.
All right, guys, the good news is you are more than halfway to the end. We know that this is a lot of information, so again, if you have any questions, just type them in the message box. And if we don't have time to get to those questions at the end of the presentation, we'll get back to you after the presentation. So moving on, we're going to talk about, and we kind of covered this earlier in the presentation, but just to reiterate the moving pieces that happen in your 401k plan. The record keeper, which is the investment provider where the actual money is held, they take care of the investment transactions, the participant reporting, and the education for the plan.
Your third-party administrator, which is NOVA, is going to handle the compliance testing and consulting, the plan design and plan document drafting of those legal plan documents, distribution and loan consulting and processing, and the government reporting and disclosures. And then, of course, we have your investment advisor that takes care of the client relationship, has the annual review of your fees and how the funds are doing, can consult with you and your participants on those funds, and also deals with the enrollment opportunities, whether they're enrollment meetings or I guess these days would be virtually. But so just to give you a little overview again of the moving pieces and who's involved, now we'll step into how some of these things happen and who takes care of those. And the first is, how does your money get to the record keeper? So most record keepers provide a secure website in which you can upload that contribution information. Typically, if you have more than 15 employees, you'll have a template that you can have the employee information, including the deferrals, and that can be uploaded into the investment provider. If you have just a small handful of employees, you might want to manually upload those individually. But I would say if you have more than 15 people participating, you'll probably want to have that template to be able to upload that information. Once that information is uploaded, the record keeper will track that information by source. So if you're uploading the 401k deferrals, they will track the pre-tax portion as well as the Roth portion if that's allowed in your plan, and then also any of the employer contributions, whether it's the safe harbor contributions, the profit sharing contributions, or the discretionary match. They will all be tracked separately. Who calculates an employer match? If your plan offers an employer match, there's a couple of possibilities here. The first is you may decide to calculate those payroll by payroll, and that just means that the participant would receive a match on that compensation and deferral for that pay period. Typically, that's calculated by the plan sponsor because there wouldn't be a very efficient way for NOVA to get that information for every paycheck and calculate those for you. However, we do have some templates that we can input your formula, and you could just drop in that compensation and deferral information and have that calculate for you. The second option, and actually is pretty widely used, is the annual match, and that's when we get your annual census data at the end of the year, typically in January through March timeframe. When we get that census data, we're completing your compliance testing. In addition, we can complete the match calculation as well, and then provide you with a schedule, both in Excel and a PDF version of how much that match is by participant. And then you can use that Excel file to upload to your record keeper. The Form 5500, Karen had mentioned earlier, the 5500 is required each year. And unless it's a special engagement, NOVA will provide that 5500 for you. So once we complete our testing season, we will move right into 5500 season and complete those 5500s for you, and then provide a link for you to sign them electronically, which is required for all 5500s to be signed electronically. How does an employee get distribution paperwork? You know, it's always the participant. They're eager to get their funds once they've terminated employment. And so we suggest that you give that employee the paperwork to that employee. Employer give that into the employee once you're doing their exit interview. When you give their COBRA notices and other medical information, you can give that notification that they have money in the plan and give them a form. So this would help meet a couple of requirements. First, you've let them know that they have money in the plan, and that can start that 30 to 45 day counter that Karen was talking about earlier for forcing participants with less than $5,000 from the plan. So that can start your clock right at that time period. And then also the participant won't have to come back to you and get paperwork, and we can make sure that the plan is kept clean. Notices. There are a lot of notices that can be required for your plan, and several of these are for each plan, and we'll go through these couple of notices here that are for all plans, and then some are for if you have that provision in your plan. But in all cases, you will be required to distribute these notices to participants. We do have a sister company that can help with the notification mailing, but if you do not have that service or are not interested in that, then you just need to be aware of these notices so you can distribute them. The first is the summary plan description, and this is the layman's term booklet of the plan document. So the plan document would be your legal document of all the provisions of your plan. And that summary plan description would be more of a question answer type booklet for the participant. And that's required to be given to every participant. I would advise that you give that summary plan description with the enrollment materials for the participant. And again, that will meet a couple of requirements. First, you can give it makes it easier that you can give it with the enrollment materials. And secondly, you always know when that's given to a participant in case of an audit. You can say, I always include it with the enrollment packet. The summary annual report, we talked about the 5,500 that's required each year. The summary annual report is a one-page summary of what that 5,500 includes. So it will say the plan had earnings of this much, the plan had distributions of this much, the total assets at the end of the year is this, and that is required to be given to participants every year. Special tax notice, this is part of the distribution form. Some vendors have this special tax notice be part of the form, and some vendors, unfortunately, is not included, and it'll be a second attachment. But the special tax notice notifies employees of what their tax ramifications will be, depending on how they take a distribution. Annual safe harbor notices. Karen had mentioned earlier about the safe harbor formulas and why you would want to have that in your plan. That is required to be communicated to participants each year. So we will provide a notice with the plan document, and then you'll simply put what year that it's applicable for and forward that to your participants each year. And that's required 30 days prior to when the safe harbor is effective. So if the safe harbor is effective for 2021, you'll want to distribute that notice by December 1st, 2020 for 2021. The annual 404A5 fee disclosure notice, that is just what it says. It's a fee disclosure talking about the fees that are associated with the funds in your plan, as well as any participant fees that may be assessed, which would be distribution fees, loan fees, any of those types of ad hoc type of fees that are only addressed if a participant takes the processing of a distribution or a loan. And the annual automatic enrollment notice. Some plans have automatic enrollment where participants are opted out, would have to opt out of a plan rather than opt in. A lot of employers like this option because just for general inertia of an employee, they don't fill out paperwork even though it would benefit them to be in the retirement plan. So some employers decide to have auto enrollment in their plan to try and help the participants and get them in at some percentage. Typically it's 2 or 3% that they would be entered into the plan, and that would happen automatically upon eligibility unless they opt out of the plan. So it can be very beneficial to help employees save that would like to be saving, but just don't take the time to fill out the notification or the forms to do so. We're going to go into some distribution basics, and unfortunately with the COVID pandemic, there have been participants who have been financially impacted. And so this year, the CARES Act was enacted and signed into regulations to allow participants to take certain distributions and loans if they've been financially impacted by COVID-19. You would just check with your account manager to see if your plan allows that and if your participant would qualify for that distribution. But there's some good benefits for people who need access to their plan or their funds rather, due to the financial impact that COVID has had this year. But other than the COVID withdrawals, there are some basic withdrawals that have been allowed in plans since they began. Some of these are discretionary. You don't have to have these in your plan, and some of them are mandatory. So a couple of the reasons the participant can take a distribution is termination of employment or retirement, age 59 and a half, a hardship distribution, or death or disability. So the termination of employment is required. And so when a participant terminates employment with your firm, they'll be eligible to take their funds as of the date that your document outlines. It's important that if those distribution forms are provided previous to a participant terminating, that distribution cannot be processed until after that termination. The plan needs to have a distributable event in order for that distribution to occur. And so even if it's turned in before the distribution, or rather the termination, it can't be processed until after that termination date. And as we talked about, the special tax notice, that needs to be provided with that distribution form. For age 59 and a half distribution, this is also called an in-service withdrawal. And this is discretionary. You don't have to have this in your plan, but a lot of plans want to allow this in their plan. A lot of plan sponsors want to allow this in their plan so that participants know that they can have access to their money when they're getting ready for retirement. So they may want to diversify their assets and move those assets to their own financial advisor. They can still contribute into the plan that they have with you, but they can also move that money continuously to their financial provider or just in one lump sum so that they can get that ready for their retirement. Hardship distributions, again, this is discretionary, but a lot of plan sponsors want to offer this just in case a participant really needs to get their money out of the plan. And the good thing is that the hardship is specified for several reasons that are allowed by law, and they are preventing foreclosure or eviction from a home. Actually, I think we have a slide on this. Yes. To purchase a principal residence, unreimbursed medical expenses, education, casualty losses, and burial expenses. So having these specific reasons by law alleviates the plan sponsor from having to make the decision of whose distribution is a hardship and who isn't. This is very specific, and documentation would need to be given in order to take one of these distributions. But it's a good allowance of a participant to be able to get to these funds if they have one of these events taking place. So they would be more willing to put money in the plan knowing that they can get money if they really needed it. But they need to be aware that not only is it going to be taxed because you're taking a distribution, but it's also subject to a 10% early withdrawal tax if the participant is less than 59 and a half years old. So they need to be aware that, yes, they can get access to the funds, but there is going to be a penalty associated with it if they're under 59 and a half, and taxes will be due on that distribution. So in 2019, there was some new guidance that came out. Previously, there were several restrictions on a hardship in addition to meeting one of those requirements. The first was if your plan allowed loans, you had to take a loan before you were able to take a hardship distribution. That is no longer the case. You don't have to take a loan before a hardship. A participant can just take the hardship. No longer have to stop contributing to the 401k plan. Previously, you would have to stop your deferrals for at least 6 months. And that was mainly just because it was kind of counterintuitive that if you needed this money, then maybe you shouldn't be depositing additional money into the plan, that maybe you should take a break for a little bit, collect yourself, get your things paid and in order, and then start back into the plan so that you won't have to incur taxes and penalties for taking a distribution. Investment earnings on deferrals were not previously allowed for withdrawal, but they are now. Employer contributions may have been available for hardship distributions, but safe harbor was not. So now you can allow employer contributions, including the safe harbor, to be allowed for just hardship distributions. And this is important because some plan sponsors say, I don't mind offering the hardship, but I really only want the participant to take the money that they put in the plan, not money that I've put into the plan on their behalf. That was really for their behalf on retirement. So you can pick and choose which sources of money that participant can take those distributions from. Unfortunately, some of our participants are going to pass away, but it's important that the participant have a beneficiary election on file. If that participant does not have a beneficiary election on file, there is a hierarchy under the plan to distribute those funds, and the first person is going to be the spouse of that participant. So if you don't want your money going to your spouse, make sure you fill out that beneficiary election form. Let's see, age 72 and a half, age 72 distribution. It's hard to say age 72 because since retirement plans have started, it's been age 70 and a half until just a couple of months ago. So at age 72, as of 2020, a participant is required to take partial withdrawals from their account. And that's simply because Uncle Sam wants to start getting their tax money on that money that they've deferred taxes on for these amount of years. So once you turn 72, there will be a formula that's calculated based on your account balance and your expected retirement age. There's a, lifespan. There's a chart that's used to figure that factor, and then that calculation can be done to determine how much needs to be withheld for each of those years. And in the October timeframe, we go in through all of our plans and run reports to see who is turning the age, previously 70 and a half, now 72. And we will run reports to see who may need to take a distribution. You are not required to take that distribution unless you're terminated or are an owner of the firm. So if you're terminated and you've turned 72, you will be required to take a minimum required distribution, but you can still take one even if you're not terminated, but it's only required if you're terminated. So you'll find that we're going to determine who has met that age requirement, and then we're going to send you a listing of employees saying, can you let us know of these participants who are 72, who's terminated, so that we can complete the forms for you to be able to make their distribution. I know that was a lot of information, so if you have any questions, just let us know. Quadros, these come up from time to time, typically in a divorce situation. If you receive a domestic relations order, please, please, please send them to us to be reviewed. There are a lot of rules associated with quadros, and we want to make sure that they've met the requirements before they're processed. So if you have one, simply send it to your account manager. We'll review through the domestic relations order, make sure it meets all the requirements, and then notify the participants and the alternative payee of what their options are. Spousal consent. Typically, spousal consent is not required for taking a loan or a distribution, except if you had previous money purchase pension funds in the plan that was more than $5,000. So if it was more than $5,000, that may be required, but in almost all cases, the spousal consent is not required. Now we're moving into loans, and this is an optional provision for your plan. You don't have to offer loans, but again, some plan sponsors decide that they would like to give participants ability to take funds if they wish. And loans are more attractive to plan sponsors because they know that the participants are going to be paying that money back and that they'll still have that money at retirement if they're able to pay that loan back in that time period. In addition to the distributions that we talked about earlier for the COVID-19 pandemic, there are also certain loans that can be taken under that same Relief Act. These are only offered if your plan already had loans. So if you have loans in the plan, you can also offer these special loans, and those special loans carry different dollar amounts that can be taken. Typically, you can take up to $50,000 or half of your vested account balance for a regular loan. For these special circumstance, for these COVID-19 distributions and loans, for that loan, you can take up to $100,000 on 100% of your vested account balance. So you can see that the limits are much higher and are for a limited amount of time, and it's specifically meant to help people who have been financially impacted by COVID. But going back to the regular provision of loans, again, you're not required to offer them, but they are popular among plans so that participants can get access without having a taxable event and can just pay themselves back the loan. And they would also pay themselves back the interest. All loans would still need to have a reasonable amount of interest charged, and that would be 2% over prime typically. Again, here are the limits for a loan that is not COVID related, and that's 50% of your account balance up to no more than $50,000. Typically, plans will have a minimum loan of $1,000, and that's mainly so you don't have your retirement plan become a savings account. You don't want participants putting money in, then taking money out, putting money in, then taking money out. Not what the intent is, but it's nice to have the option. And so we usually advise that you put in at least $1,000 minimum into that loan provision. And that would mean that a participant would need to have at least $2,000 that's vested in order to take that $1,000 loan. Again, there's a reasonable interest rate. Loans can be repaid within 5 years unless it's a residential mortgage loan. So if you have a participant taking a loan for purchase of a principal residence, including a down payment or the closing costs, that can be up to a 20-year loan. Now, obviously, we want to make sure that's reasonable. We don't want somebody taking a $5,000 loan for a mortgage and or for a regular principal residence and paying that over 20 years, because that's going to be such a small amount. We want to make sure it's reasonable, but they can take it up to 20 years. And these loan repayments are made through payroll deduction. So the participant isn't going to be sending you checks. You don't have to track them down for their loan repayment. It's going to come directly from their payroll, and you'll upload that loan repayment similar to how you upload the deferral and pre-tax and Roth deferrals to the record keeper. If a participant terminates when the loan is still outstanding, they have the option to repay in full, or they can unfortunately default on that loan. And defaulting on that loan just means that they will receive a 1099 at the end of the year, and that outstanding loan balance will be taxable. So they need to be aware that they are going to have this taxable distribution if they default on that loan. But it's not like a ding against their credit. It's going to be in the retirement plan, and they're going to become taxable on this distribution. There are fees for loans. There's usually a loan initiation fee, and depending on the record keeper, that can be an annual or a monthly maintenance fee. So again, participants need to be aware of that, and those information can be found in the fee disclosures that they receive each year. The fastest way to get a loan is for a participant to apply online if they have that functionality as a record keeper. And once that's approved online, they can also request an ACH debit instead of a paper check. So I know that you probably have participants come to you and want their money quickly. This is a couple of key bits of information that we can give you to help them out with that money. So we just have a few minutes left. So I want to go over an annual calendar of what you can expect for your retirement plan each year if you've not been through a full year here at NOVA. I'm going to just hit on a couple of these things because a couple of them just map over from month to month, and that would be the entry date. So depending on the entry date that you have for the plan, that would be determining when you're distributing enrollment materials and where you would fall on this chart. Excuse me. An entry date, just to remind you, is the date in which a participant can enter the plan once they've met the eligibility requirement. And typically that can be semi-annual, but it can be as of the date that they met the requirements, monthly, quarterly, and that for that reason, that's why they show up on each month of the calendar. But just going through some highlights on here, the 1099s are distributed from the record keeper no later than January 31st. So those 1099s are going to be for participants who have taken a distribution during the year, or they've taken a loan and defaulted on that loan. Hopefully in January, you're going to be submitting your year-end census data to NOVA. And I say hopefully because the earlier we get your information, the earlier we can get your testing done and meet the deadlines for the March 15th deadline in case your plan fails deferral testing and needs refunds. So we will send out a data request to you in early January. And once you get that data request, you can go on and fill the questionnaire in and then the census data, and we can get started on your testing. Fourth quarter statements are going to come from the record keepers. The record keepers send their statements to the participants each quarter. So again, you'll see this multiple times on the calendar as well. Moving over to February, again, you're submitting year-end census data if you haven't done so in January. NOVA will be working on all that annual compliance testing for the censuses that we've received. In March, this is the deadline I spoke of. March 15th is when the deferral and match refunds are due to participants if the plan failed their testing. And this is important because any refunds that are processed after March 15th will get a 10% penalty imposed per regulations. It's not a NOVA penalty, but that will be paid to the IRS for 10% of whatever the refunds should have been by March 15th. So it's important to get us your data as early as possible so that we can help you meet that deadline and not incur any penalties. Moving on to April. April is going to be the first deadline for participants who are age 72 and required to take a minimum distribution. That first distribution for them is going to be due by April 15th. That will be ongoing distribution. Also, it's a deadline for excess 402G refunds. And this is for participants who defer up to the maximum. For 2020, it's $19,500 plus $6,500 in catch-up. If for any reason a participant went over those limits, which is typically easy for a participant to do if they switch jobs, they might not realize that they had already met the maximum between the two employers. And so we need to make sure that if they did exceed that 402G limit, that it's processed by April 15th. If it's not, the participant does incur double taxation for that amount that should have been refunded by April 15th. May, the NOVA will begin working on your Form 5500. So once we have the testing done for your plan, we will move on to the 5500, which will be due in July. For large plans, if you have over 100 participants, the plan audit should begin. The earlier that plan audit can begin by the independent CPA, the earlier the 5500 can be filed with that audit. June, again, we're going to be continuing working on that 5500 and the audit work. July 31st is the first due date of the 5500. So if we have your completed data for testing, we're going to complete that 5500, and our intent is to get that to you within no more than 30 days before this July 31st deadline, so that you have time to review the 5500 and file it online. But the 5500 can go on extension if for any reason that data is not completed, and that extended due date will fall down here further in October 15th. But October 15th will be the latest a 5500 can be filed, and there are penalties for IRS and Department of Labor per day if that is not filed timely. So we want to make sure everyone is filed by October 15th. Let's see. Mid-year testing, you'll see an email come from Nova. If your plan typically fails ADP testing, we'll complete a mid-year testing or offer you a mid-year testing to see if you want to see where your plan will fall on that testing and if refunds may be required, and maybe make some tweaks to those deferrals so that you can get a passing result when the final testing takes place. Let's see, September is the date that the summary annual report, remember that's the report that summarizes the 5500 data. If you have a due date of July 31st, that is due by September 30th for the summary annual report. So again, if you are filing your 5500 prior to July 31st, you need to distribute the summary annual report to participants by September 30th. September is also when we will begin the mandatory cash out projects. And that mandatory cash out is what Karen had talked about earlier for participants who have less than $5,000. We'll go through our plans and determine who is terminated and has less than $5,000. And if those participants do not respond within 30 days of how they would like their funds taken, then we will roll them to an IRA. Let's see. October is when we will start pulling those reports for you to see who is age 72 and who may be required to take a minimum required distribution. Let's see. Let's just go to send notices. We want to make sure that any safe harbor notice, default investment notice, and the auto enrollment notice, if you have the safe harbor and auto enrollment in your plan, that you distribute those notice no later than December 1st, and that will be applicable for the next year. So December 1st for 2020 would be the notices that are required for a safe harbor or auto enrollment for 2021. I think that's probably all that we're going to have time to go over. Again, I mentioned earlier that our sister company AFS is available to help you with mailing annual notices each year. And here's the information on that. If you're interested in that, take down that information and contact Jake, and he can set you up and help you out with those notices each year. Upcoming webinars, we have webinars scheduled throughout the year, so just visit our website and you can sign up for those webinars there. At the end of our presentation, you'll receive a survey, and you can just fill that survey out, and then you will receive your CPA credit certification within 1 week. And lastly, I've included Karen and I's contact information here. You can, of course, type your question into the questions box, and we will get back to you after the presentation. But otherwise, you could also reach out to Karen and I directly if you have any further questions. So I think that's all for us, unless, Jasmine, do you have anything that you need to add?
Yes, thank you guys. That was a lot of great information. And thank you to everyone for joining us today to talk about 401k plans. Just as a reminder for those questions that were submitted, since we ran out of time, we will be reaching out directly to each of you via email to have these answered within 1 to 2 business days. Please note there will be a survey sent out in a follow-up email within an hour or so, so just be on the lookout for that. The certificates will be sent out in 1 week, and the recording of this webinar will be made available on our NOVA YouTube channel sometime next week. If you have any questions, please reach out to your account manager and they will be happy to assist you. And for any other questions, please email us at webinars@nova401k.com. Everyone have a wonderful Wednesday.